you need to be out of the dollar and into the investor class, because that widening gap between those who own things, who own assets, and those who do not is going to continue to widen. Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, and today I am going to do something a little bit different. I'm going to kind of give you my perspective, maybe predictions, I dare say, about the upcoming year in 2026, how I look at it, what I think is likely outcome, and why. Not that I am any smarter than any of you on this stuff, but I've actually kind of sat down and thought about, the things that are going on in the macroeconomic side of things, and put some stuff together. And hopefully you'll enjoy it. We'll have that right after these messages.
Wealth Formula Banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, the strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash-flowing investments. Here's the key. Even though you've borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. Net result, you make money in two places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back, everyone, and Happy New Year to you. I forgot to even say that in the intro. How rude of me. Hopefully you had a great holiday, you had a great Christmas, and you're bringing in the new year with a vision of health and wealth and prosperity and all that stuff. So anyway, let's talk a little bit about, what I am kind of looking at for 2026. Now, when you think about, what are these predictions and what could they be and all that, interest rates, inflation, markets, let's set the foundation for how I'm thinking about it, because everything else really kind of builds on it. And the most important thing to understand is that debt is really now, I think, the main character in the economy. I know people have been talking about this for a very long time, but I think the debt issue is really, really becoming something that cannot be ignored. And I'll get into that in a while. Obviously, I'm not saying that inflation and interest rates don't matter. They matter enormously. Those are the things that people actually feel, right? Higher prices, higher mortgage rates, higher insurance costs. But what I'm saying is that the level of debt now determines really how decisions on those things are made from policymakers. How do they respond to inflation and interest rates, recessions, market stress? What debt does is it actually kind of limits the range of choices around how policymakers react to all these things. So once you see that, the behavior of the economy starts to, I think, make a lot more sense. So let's start with sovereign debt. And I'm going to start really basic here, because the question is, what exactly is sovereign debt? Okay. And sovereign debt is the money a government owes. Okay. In the U.S., it exists because the government consistently spends more than it collects in taxes. And that gap is called the deficit. When that happens, year after year, you have an accumulation of debt. Now, when debt is low, it's pretty manageable, right? But when debt gets very large, it starts to influence policy decisions. And that's where we are right now. Here's the key mechanic that I think most people don't really think about, right? Governments don't pay off debt the way you and I, pay off our debt, like a mortgage or whatever. They always refinance it, right? So when the U.S. government borrows money, it issues bonds. That's how it does. Those bonds have maturity dates. And when you buy a bond, you're loaning the government money. So when a bond matures, the government owes that principal back to you, right? So that's kind of how we talk about debt. But the government doesn't save money over time to pay off that bond. Like, I mean, that's the way you would think about it for you and me, right? I mean, at some point you're like, I really need to pay off this debt. I'm just going to pay it off with this money that I saved. Instead, what they do is when a bond comes due, it issues a new bond and uses the money from that new bond to pay back the old one. Okay. Now, if that sounds familiar to you, it's because it's pretty much what we would call in plain English refinancing, right? Now, imagine, though, the government issued a bond a few years ago when interest rates were near zero. That bond matures today. Interest rates are much higher, right? To pay off the old bond, the government issues a new one at today's higher rates. So the debt doesn't disappear. It just becomes more expensive to carry, right? I mean, it's just like you got a mortgage. You had a great rate, but you only got it for 7 years, and also you got to refinance it. Gosh, all of a sudden that rate went really higher and your payments are much higher and the debt payments going up, for the government. What adds to that deficit? It's a really, really vicious cycle. Now, take that process and multiply it across trillions of dollars of debt. And now you can start seeing why interest rates matter so much in a high debt system. Now, what makes this especially important right now is that for over the last several years, the U.S. issued a very large amount of short-term debt. Short-term debt matures quickly. And that means large portions of government debt come due every year and have to be refinanced at whatever the interest rate exists at the time. So even if deficits stop growing tomorrow, which they won't, the government would still need smooth, functioning financial markets just to keep refinancing what already exists. Now, this is why the economy has become so sensitive to interest rates, liquidity, and confidence. Higher interest rates increase the cost of refinancing, right? We've mentioned that already, and that pushes deficits higher and forces even more borrowing. So I mentioned liquidity. What is that? Well, liquidity is about how easily money moves through the system. When liquidity is good, bonds are easily absorbed. Banks lend. Markets function normally. And when liquidity dries up, refinancing becomes fragile, and that stress in the market spreads quickly. And then finally, confidence. I mentioned too. Why does confidence matter? Well, confidence matters because investors need to believe that the system is going to hold together. When confidence weakens, guess what happens? Well, what would happen if you think about it with a loan, a higher risk loan? Well, investors demand higher yields. Like refinance, it becomes even more expensive and problems compound fast. Now, this is why policymakers are extremely uncomfortable with high borrowing costs, reduced lending, falling asset values, and deep recessions. Recessions, by the way, don't make debt easier to manage. They make it harder by reducing tax revenue and worsening debt ratios. Now, that brings me to something that I am feeling sort of back and forth with, a listener who sent me some commentary about, the fear of going back to 1970s, 80s style interest rates. But the thing is that I just don't think that comparison works, and here's why. Okay. So in the 1970s, the U.S. had far less debt. Interest rates could go very high without threatening the government's ability to refinance itself. Now, today, with debt much larger relative to the economy, very high rates don't just fight inflation, they stress the entire financial structure, right? You can't just say, we're going to make super high rates because that cost of all that debt that the government has is going to be extraordinarily expensive. Now, that doesn't mean that rates can't rise. It means policymakers have far less tolerance for how high and how long rates can stay elevated. It's a completely different system from the 1970s and 80s. So I think trying to put things into that context is probably not not a good way to think about it. So why am I focusing on this right now instead of a few years ago? Because again, we didn't suddenly become a high debt economy this year. So what changed? Well, timing. A massive amount of debt that was issued at very low interest rates, as I mentioned before, is now maturing and being refinanced at much higher rates. And that shift is no longer theoretical. It's happening in real time. Last year, much of that low rate debt was still in place. Interest costs hadn't fully reset, but going into 2026, they have. Now, I keep talking about, how much we're paying in interest, right? Because again, that's a big difference between now and the 1970s when you could have, you didn't have as much debt, so you could pay more interest on it, right? Now, the U.S. is now spending roughly $1 trillion a year just on interest. For perspective, right? I mean, what's $1 trillion? What does that even mean for the normal person? Well, for perspective, that's the defense budget. $1 trillion. It's more than Medicare, more than most major federal programs. And the thing is that money doesn't do anything, right? It doesn't create growth. It just services past borrowing. And this is the point where debt stops being background noise, kind of an annoyance that people just say, well, we'll kick it to the next generation. It starts actively shaping policy decisions because it's a thing that you got to pay for. You got to keep paying for it. So the takeaway I want you to carry forward is simple. We now live in a system where policymakers don't have the luxury of letting things break. When debt is low, governments can tolerate deep recessions like you saw in the 70s and 80s and long recoveries. When debt is high, they can't, because even small shocks can just really get out of control quickly. And that's the framework I think that I'm using as we move into interest rates, inflation, and what all this means for markets going into 2026. So let's talk about interest rates. You've heard me say that I think that interest rates are going to come down. They're going to continue to tick down a little bit. I don't think a lot, but I do think there'll probably be at least one more rate cut. I think, you're probably going to have some lowering in the 10-year and in the bond market in general. But interest rates are not going to go back to 2010, right? They just aren't. And the 2010s were not normal. They were a very specific period created by very specific conditions, right? Inflation was persistently low. It just wouldn't go up. Globalization pushed prices down. Capital was abundant. Debt levels, well, they were high, but they're rising, but they hadn't become what they are now. And because of that, central banks could hold rates near zero without much consequence. And that environment, unfortunately, does not exist now. So today, debt is much higher. Inflation risk is real again, and investors expect to be compensated for lending money long term. So even when rates decline from current levels, they do not return. They will not return to where people anchor them psychologically. If they're thinking about the 2010s, they're going to settle higher than the 2010s baseline. You see, policymakers are kind of stuck. If rates stay too high for too long, we mentioned this before, refinancing government debt becomes increasingly expensive. Interest costs rise, deficits widen, and then you get that financial stress that spreads through the credit markets. But if rates are pushed too low for too long, borrowing accelerates, and that's when inflation resurfaces and confidence in the currency weakens. So then that's the tug of war. So policymakers, they can no longer choose between high rates and low rates. They're going to be choosing how to manage the trade-offs, right? So what's going to happen is that you're going to see that rates are going to move within a range. They come down when something breaks. They move back up when inflation pressures return. That's why volatility matters more than the exact level of rates going forward, in my opinion. So we're not returning to free money. We are also not headed to a permanent 1970s style high rate world. What we are doing is entering a time where borrowing costs matter again. Refinancing is not guaranteed, and rate swings are part of the system. And that naturally leads to the question of inflation. So once you understand why rates, don't go back to the 2010s, the next question becomes, well, if policymakers can't keep rates high for long and they can't push them back to zero either, then what are they actually trying to accomplish? Well, the answer is that the goal is kind of shifted. For decades, economic policy was focused on disinflation, pushing inflation lower and lower over time. And inflation was actually treated as a failure. And that made sense in a world with lower debt. In a high debt world, that logic sort of breaks down, right? Deflation, which is actually falling prices, increases the real value of debt. Think about that for a moment, like just in terms of, you have a mortgage and, sometime, your parents might have like a 30-year mortgage or something like that they've had for 25 years. And they've been paying it off and it's great. But the bigger thing to notice is the amount of money that they borrowed is actually very small in real world dollars because it's, 25 years later. See, inflation is bad when it's, you're dealing with it. But inflation is good at one other thing, which is it's good at eroding debt. It will make the amount of the value of the actual money that you owe on debt lower over time. So that's why you can't have deflation, right? You can't have deflation because that increases the real value of the debt. It discourages spending, slows growth, and makes refinancing harder. So in today's system, deflation is way, way more dangerous than moderate inflation. And so because of that, inflation really isn't something that I think is quite as important that has to be eliminated at all costs, that, you have to be right at 2%, which is, kind of what the Fed, his target is, right? Instead, what you got to do is you got to manage it. Of course, that doesn't mean you want runaway inflation. What they want to do is have enough inflation to keep nominal growth positive and prevent debt burdens from become heavier. Again, what do I mean by that? You got to have enough inflation to erode the debt that we have, right? So this is why that 2% inflation target should be understood as, kind of aspirational, but not absolute, because having a little higher inflation, it hurts people. It hurts people on a day-to-day basis, but actually helps with that. So even at, inflation sells a bit higher than the, 2% Fed target, say it's 4%. It's actually eroding, it is eroding purchasing power, but it's also eroding debt. It's stabilizing debt dynamics. And from the system's perspective, of course, that's helpful. But for us, when we're paying for things on a day-to-day basis, see the cost of eggs and all that, it's frustrating, right? And that tension between system stability and personal cost, it's one of the defining features of the economy heading into 2026. So when you see policymakers tolerate inflation longer than you think they should, or step in quickly when markets kind of wobble, it's not confusion or incompetence. It's actually constraint, because debt limits the available choices, rates are managed within a range, inflation is guided and not eliminated. Now put those together and you get the environment we're moving into, which is an economy where markets can look resilient even while people feel stretched, right? I mean, that's kind of what we're feeling. Everybody's like, oh, these markets are doing fantastic, but then, you look at consumer confidence, it goes down. It's been going down every month. This is an environment where asset prices recover faster than wages, and where understanding how policy reacts becomes a real advantage. So that's kind of my macro setup for 2026. And, with that framework, we can start looking into the first prediction I'll make. And again, these are not, crazy predictions. They are just generalized things that I think you're going to see. So like the first one is that the markets will stop being a reliable proxy for the economy. You could argue that's already happened, right? Markets and the economy kind of stopped correlating. We saw it after the financial crisis, right? We saw it very clearly even during COVID. So the decoupling itself is not new. What's new is that decoupling is no longer temporary. It's become the baseline. That's become the new normal. For most of modern history, People had a fairly reliable mental model, right? You probably do if you grew up in the 80s and 90s as a kid or whatever. When the economy felt bad, layoffs, weak growth, falling incomes, markets usually reflected the pain, right? Sometimes there was a gap. Sometimes markets recovered a little earlier, but eventually things kind of reconverged. The economy healed, wages caught up, and the markets and lived experience kind of lined up. Now, that's the model that most people still have in their heads. And that's why so many people feel so confused right now. I mean, I feel confused by it. So what's changed going into 2026? It's structural now. We're no longer living in a system where policy intervenes only during emergencies. We are in a system where policy is always on. Debt is permanently high. Rates are actively managed. Inflation is tolerated rather than eliminated. And as a result of that, markets aren't really necessarily responding primarily to how the economy feels to people. They're responding, it's responding to refinancing needs, liquidity management, confidence preservation. That's a very different signal. COVID is the clearest example of that shift, but it's important to understand it correctly. So in 2020, the economy was literally shut down, right? Unemployment exploded. Small businesses were collapsing, right? Like this is COVID. And yet markets bottomed quickly. We saw that. And then bam, all-time highs, even though life kind of felt terrible for a lot of people. And that wasn't because the economy was healthy. It was because policy overwhelmed fundamentals. And at the time, that felt extraordinary. It felt very different. Like this doesn't make any sense. What's different now is that we're still using the same playbook, but without an obvious crisis. So intervention is no longer reactive. It's preventative. So what do I predict for 2026? Well, markets are going to stop being a reliable proxy for economic health. People are going to stop talking about that like it means anything anymore. Markets going to increasingly reflect how constrained policymakers are and how much liquidity is in the system and how aggressively risk is being managed. The markets are not going to tell you about affordability, wage pressure, or whether life feels easier or harder for people, right? Those are completely it's just a standard thing now that those are uncorrelated. And the gap is not abnormal anymore. It's the operating environment. So what do you do with that information? Well, for an individual investor, this environment requires a real mindset shift, right? You can't rely on your gut anymore. You can't say, man, I feel like this economy doesn't feel good. So the markets can't look at a lot of people feel like the economy doesn't feel good to them because of inflation, because of what happened with interest rates and all that stuff, right? But you've got record-breaking stock market numbers. You can't rely on your gut anymore. Your gut is telling you the economy feels bad. For many people, that's absolutely true. Costs are high again. Things feel tight. And the instinct is to wait, to sit in cash, to assume markets would reflect that pain. But that instinct used to work. And in this system, it doesn't, because markets are no longer pricing in how the economy feels. They're pricing policy response, liquidity, and constraints. So if you wait for the economy to feel good before you act, it's going to be way too late. So instead of asking, does the economy feel weak? You need to start asking different questions. You need to ask how constrained policymakers are, how quickly liquidity will return if markets wobble in it, and where capital tends to flow first when policy steps in. In other words, you got to start really thinking about investing, right? Like you got to, like right now I've beat this over many times before, but if you're saving money right now and you're looking and you're wondering what to do, look for things that are on sale. Now, I think real estate's on sale right now, right? Get your money into the markets one way or another. That's what I would say. Whatever it is that you want to invest in, don't let your money just erode, because this lack of correlation it's a really, really important thing. And it's going to continue to happen. And you know what else is going to happen because of that? You're going to see an increasing widening of the wealth gap. People whose income is tied primarily to wages are going to experience that inflation directly, right? Their money's trapped in the real economy where costs rise faster than income. But investors, on the other hand, have an opportunity to participate in the markets that are supported by this sort of unnatural infrastructure that I just mentioned, right? Asset prices are going to continue going up. Now, I'm not here to judge whether that's a good thing or a bad thing. I'm just telling you how it functions. So the investor class increasingly benefits from asset appreciation, right? Early access to liquidity, while lower income groups often can't participate in that upside, even as their costs of living rise because they're not in the markets. They don't own assets. So again, you have to stop, using how the economy feels as your primary investing signal. If you want to protect and grow your wealth in this environment, you need to understand how policy reacts, how liquidity moves, how assets behave when the system is under constraint. And in other words, frankly, you just need to be part of the winning class, which is the investor class. All right. So that's kind of, hopefully that made sense to you. Here's another prediction for you. And this is probably more related to some of the things that we talk about usually, but I'll say that multifamily and commercial real estate are going to finish their washout and the window is going to start to really close. Again, I've talked about this before. You've probably heard me say this, but let's talk about multifamily and commercial real estate again, because, this audience doesn't need just theory. You've already lived through the pain. For the past 2 years, you've seen deals blow up, capital calls go out, refinancings fail. So the real question going on in 2026 is not whether real estate breaks. It already did. It already did. The real question is how much longer this phase lasts and what replaces it. And my view is that 2025 into early 2026 represents the final phase of this unwind and the beginning of stabilization. I'm not predicting an immediate boom, not a return to 2021 by any means, but the end of obvious distress. So what's happened already from 2022 to 2024, multifamily and commercial real estate absorbed the fastest rate shock in modern history. Many of you lived through that. I lived through that. It's painful. Debt costs doubled or tripled. Cap rates moved hundreds of basis points. Bridge debt structures broke. Refinancing assumptions collapsed. Now, a lot of the deals, I would say most of the deals that, kind of imploded shared the same DNA, peaking price purchases during peak prices in 2021, early 2022, floating rate, thinner negative cash flow based on, the rates at the time. Maybe it was positive. Business plans that were really dependent on refis and rent growth. Those deals, though, have largely already defaulted, recapitalized, or they're being quietly handed back. And that matters because markets don't keep breaking the same way forever. If you're seeing right now, and if you're in our investor club, you are, 30% discounts on a regular basis, right? On a regular basis compared to the peak. Don't assume that's going to last. That this is the key point I want to make very clearly. If you're looking at multifamily or commercial deals today that are trading at that 30% below where they were a couple of years ago, you should not assume that window stays open indefinitely because the level of discount exists because, dried up liquidity, because of that violent rate reset, uncertainty. But here's the thing, markets don't stay frozen forever. And as soon as pricing stabilizes, even at higher cap rates, which are going to be higher than they were because you're not going to see interest rates down at zero, capital is going to start to move again. And stabilization doesn't require rates to go back to zero. It just requires some level of predictability. So here's the sequence of what happens. First, the distress slows. You see less and less defaults. And then slowly but surely, cap rates stop expanding, right? That alone brings back buyers. Then as rates drift modestly lower and volatility declines, lenders re-enter selectively. Debt becomes available again. It's not cheap, but it's definitely usable. And that brings more liquidity. When I say liquidity in this context, I'm talking about just more deals getting done. And once liquidity returns, cap rates don't stay wide forever. They compress, right? It's competition. And again, when they compress, they're not going to go back to 2021 levels, but enough to meaningfully lift asset values from distressed pricing. This can happen faster than people expect, right? people underestimate the fact that there is an enormous amount of capital sitting on the sidelines right now in money market funds, short-term treasuries, private capital waiting for clarity. That capital isn't, permanent. The moment investors believe that rates have peaked, that prices have stabilized, downside risk is contained, that money starts to chase yield. And when it does, the transition from nobody wants this to everyone wants exposure again can happen surprisingly fast. In other words, I'm not saying I think this will happen in 26, but the shift from a market that is on sale, which I've described it as, to a market that is starting to look a little frothy can really be just a couple of years. And in that situation, I'd rather be a net seller, right? You want to be accumulating during this phase of for sale so that you can sell in froth. So what this means is that the market is, this is not a market to wait for everything to feel perfect. Because by the time it does, the obvious discounts are going to be gone. And if you wait for perfect clarity, you're going to be competing with institutional capital, with large private funds and yield hungry money coming out of cash. So the opportunity is not assuming distress lasts forever. It's in recognizing when the market is transitioning from forced selling, which is what is happening even now, to price discovery. So ultimately the prediction is this: multifamily and commercial real estate, that washout is completed in 2026, and the window created by distress really starts to close. Deep discounts don't persist once markets stabilize, which I think is what's going to happen. And then I think you're going to start to see a shift. You're going to start to see more deals, more liquidity, and that's going to return faster than people expect. In other words, this is going to be the end of, sort of this bargain basement, panic pricing. And once real assets stabilize and liquidity returns, attention inevitably turns to the currency those assets are priced in, which brings us to the prediction number 3, the dollar. Okay, the dollar doesn't collapse, but it does continue to erode. It slowly leak, right? Let's talk about the dollar, because you hear about this all the time, right? Ad nauseum, you hear the weakening of the dollar. This is one of those topics where people tend to jump to extremes. On one side, you hear the dollar is about to collapse. On the other side, you hear the dollar is strong and everything's fine. I think the truth is somewhere in the middle. And my prediction for 2026 is simple. Again, the dollar doesn't implode. It doesn't get replaced. It just continues to erode slowly but surely. And that's how reserve currencies actually behave when debt gets high, right? So why no collapse, right? Because you got people out there worried about the collapse of the U.S. dollar. The U.S. dollar is going to remain dominant, not because it's perfect, but because there's no real alternative at scale. There just isn't. Okay. There's no other currency with markets as deep, as liquid, and as widely used for trade, debt, and collateral. So, reserve currencies, we hear about the worry about us being the reserve currency. Well, reserve currencies don't disappear overnight. They erode gradually, but they don't disappear overnight. And that erosion shows up not as a crash, but again, as persistent inflation, right? As rising, real asset prices, which is, again, where you want to be, and a slow loss of purchasing power over time. And again, that brings us back to that whole issue of debt we were talking about, right? So in a highly indebted system, policymakers are not incentivized to aggressively defend the currency at all costs, right? So very high interest rates might strengthen the dollar in the short term, but they also make debt harder to service and financial stress worse, right? So instead of choosing strength or collapse, policy drifts towards tolerance, right? Inflation is allowed to run a little hotter than people expect because, again, it's going to erode that debt. The currency weakens slowly, therefore, rather than violently, right? Again, currency weakening, it's so entwined with this idea of inflation because debt becomes easier to manage in real terms. And one of the things I hear, and I've been sort of in these conversations back and forth with at least one of you out there in emails, is that, I hear that there's a serious problem for interest rates because of, China selling U.S. treasuries. And because of that, you might get the collapse of the dollar. In fact, in this conversation, it was not only about China, but also Europe, which, I hadn't actually heard anybody mention that before, but I guess that's out there in the ecosystem and some of the newsletters. Now, all that sounds scary, but it really misunderstands how the system actually works. What exactly happens when someone or a country sells treasuries? Well, they don't just destroy the dollars. What they're doing is they just swap $1 asset for another, right? The dollars don't even leave the system. They change hands. So this idea of China selling off all its treasuries, well, China's been reducing its treasury holdings for years, and the dollar hasn't collapsed. The market absorbed it because treasuries are the deepest, most liquid market in the world. And then this idea of Europe actually dumping treasuries because, they're not happy with Donald Trump and what he's doing in Ukraine and all that. That would be an absolute nightmare for Europe. That would hurt their own economy. That's the last thing that an indebted government wants. So foreign selling, yeah, sure, it's going to move yields, but it's not going to implode the dollar. But the reality of the erosion of the dollar is real. I don't think anybody questions that anymore. And I think that is another reason that you need to be buying real assets. You need to be buying equity. You need to be on the side of the investor class. Okay. That's how you combat all of this. So the real takeaway here ultimately is that, it isn't to abandon the dollar, right? It isn't. It's just to stop pretending that holding cash is neutral. It's not. Most of your wealth sits in assets that can't adjust, that can't grow as asset prices grow. Then you're making a bet on currency stability that literally no one believes is going to be the base standard anymore, right? Everybody knows, every economist, every country, everywhere knows that these currencies are eroding. You don't freak out about the dollar, but don't be like heavily in dollars. Start getting into the markets. All right. Well, I'm talking a lot about esoteric macro stuff, but let's kind of get into some stuff that you might think is fun, more fun maybe. Okay. A lot of you are into Bitcoin. Well, I think that, the Bitcoin is going to continue to mature, and the next leg up looks like, because of more adoption, not because of hype, which isn't maybe not as fast and violent, but it's a lot more predictable. For those of you who are still, unfortunately, listening to the likes of Peter Schiff about Bitcoin, you got to stop doing that, because Bitcoin is not tulips, right? A lot of people still talk about it like it's a fad that could just vanish, but we're long past that phase. Bitcoin is like $2 trillion asset. And in the history of the world, there has never been a $2 trillion asset that went to zero. Is it volatile? Yeah, it is. It can absolutely continue to be wildly volatile, but it's not going to zero. And my prediction is not overly crazy. It's just that Bitcoin is going to continue to increase in price, but it's not because of speculative, because it's a speculative trade anymore, right? I think it's because of adoption. Adoption is going to become the real meaningful driver of market capitalization. So what do I mean by that? Well, it just means more people are seeing it as a real asset, and it has to become, when it becomes a real asset class, everyone has to have some of it. Every major institution has to have some of it because it's its own asset class. And when they do that, it just drives up the entire market capitalization of that asset. And when you have an asset that has a finite amount, which in the case of Bitcoin, there will never be more than 21 million Bitcoin, and you have constant adoption, constant slow but persistent growth in market capitalization, the asset has to become more expensive. Now, what do I mean by this adoption? Well, places that you would never think in a million years, a few years ago, that would be buying Bitcoin or, ETFs, Bitcoin ETFs are doing so. Harvard is a great example because it's not a crypto influencer, right? It's actually one of the most conservative, brand sensitive pools of capital in the world. But their endowment management disclosed roughly $443 million in its position in BlackRock iShares Bitcoin Trust, which is IBIC for those of you who don't know. That's how you can just go to your New York Stock Exchange and buy Bitcoin ETFs with IBIT. Now, whether you love this whole Bitcoin idea or hate it or whatever, that's a signal that is increasingly treated like a portfolio asset. It's not a fringe experiment. And it's not only universities, institutional comfort it's just there, right? Custody, regulated vehicles, positioning size, risk controls, those kinds of things are all become part of the Bitcoin environment. Many countries are already holding meaningful amounts of Bitcoin. Even the U.S. has. There is a formalized Bitcoin reserve. Now, we aren't actively buying it, but here's an interesting thing. With Bitcoin, you can, when it is, the way that the U.S. is accumulating Bitcoin is through seizures. All right, bad guy gets caught, his boats, his house, and his Bitcoin get confiscated. So the U.S. will sell the house, they will sell the gold, they will sell the boats, but they will keep the Bitcoin. What does that tell you? And there's a lot of nations that are actually openly holding and buying Bitcoin. I mentioned the U.S., China. This always seems to be, anti-Bitcoin. Well, they actually own quite a bit. The UK, Ukraine, Bhutan, El Salvador. Bottom line is there's a big change in narrative, right? That this is a real asset. That this is something that, even if it's 1% of a major institution's assets or less than that or whatever, it's part of it. And that adoption alone can move prices from here. And that's what I think a lot of people miss because they're like, well, I already had a big move and, it's at 100, it's 80 or 90 or 100, whatever. It's not going much bigger than that. Well, Bitcoin is actually really small relative to global pools of capital. So at this stage, adoption alone, not even the crazy mania of the past can make a non-trivial increase in market capitalization and therefore a non-trivial increase in the actual price of Bitcoin. All it's going to take, and you're going to see this, you're going to see more endowments, you're going to see more sovereign wealth pools, pensions, model portfolios. All that they decide when, even with a small allocation, right? It doesn't take too much to overwhelm the available float because Bitcoin is scarce and a lot of it's held tightly. So as far as Bitcoin goes, what do I think is going to happen? I believe all-time highs are going to get challenged. They're going to get broken again in 2026. Not because, again, everyone's suddenly becoming a crypto maximalist, but because adoption's just going to continue to grow. The wild card, I should say, is that the U.S. moving from we hold what we seized in terms of Bitcoin to actively acquiring reserves could be an enormous catalyst. And there is a lot of talk about this right now. If the market ever believes that the U.S. is a consistent buyer, even in a constrained budget neutral way, that changes the psychology fast. And in that scenario, I think $200,000 plus Bitcoin by the end of 2026 becomes very plausible. Zooming out, I've said this before, you may think I'm crazy, but again, because of adoption, I think that Bitcoin is at $1 million 5 to 7 years from now. So what does that mean for you? Well, I think at the end of the day, if you don't own some, you might want to. I'm not going to give you financial advice. But again, just like Harvard's doing it, major endowments are saying, well, maybe we'll just buy 2% of that. 2% of our endowment will be made of something like that, right? It's just even a very small amount. But exposure to it makes a lot of sense. So I think that is something to highly consider if you are still on zero when it comes to Bitcoin. All right, now here's my last prediction. And you may have heard me talking about this before as well, that AI becomes a deflationary force that policymakers finally wake up to. And I think this is actually one of the most important and misunderstood economic developments that is currently already out there, but I think it's going to be really recognized by the end of 2026. Okay. Artificial intelligence is going to stop being just a tech story and it's going to become a macroeconomic story. I think that by the end of 2026, artificial intelligence is clearly, it's clearly going to be boosting corporate earnings while beginning to materially reshape the labor force. And what's going to happen is that central banks and policymakers are going to start treating it as a genuinely deflationary force over the next several years. And they're going to try to have to figure out what to do about it. And again, going back to our earlier conversation, because deflation is really a real problem for a country with an enormous amount of debt. So let's get a little bit into the whole deflationary conversation. So artificial intelligence at its core is a productivity machine, right? It allows companies to produce more with fewer inputs, fewer hours, fewer people, fewer mistakes, and productivity always shows up in profits before it shows up in everyday life, right? Now, lower cost per transaction, faster execution, fewer people doing the same amount of work, widening margins without price increases. That's the tell. That's when profits rise without raising prices. Something deflationary is happening underneath the surface. And the biggest impact there is the labor market, right? It's going to be impossible to ignore. And this is where the conversation really shifts, because artificial intelligence doesn't need to eliminate jobs outright to matter. It only needs to reduce the number of people required to do it, right? So you're thinking the labor markets, you're going to see a lot of this. You're going to see more slowing in hiring, even while productivity expectations rise. And I think by late 2026, the public conversation is going to change from will artificial intelligence affect jobs someday to why aren't companies hiring the way they used to? And of course, that's when people are going to start paying attention. And they're going to notice it's deflationary because it's going to be, because artificial intelligence is going to push down the cost of services, administration, customer support, research, and eventually decision-making itself. That's why it's deflationary. It's structural, right? Just think of all the things you can do for so much cheaper. That is what deflation is, right? And again, we mentioned before, deflation is not something central banks are comfortable with because of debt and because debt-heavy systems rely on nominal growth. Deflation makes debt heavier in real terms, as opposed to what we said before, which is that inflation actually erodes debt. And that is a very, very challenging problem. And by 2026, I think you're going to hear a lot about this, policy problem that we have, which is innovation versus, deflation.
You make a lot of money, but are still worried about retirement. Maybe you didn't start earning until your 30s. Now you're trying to catch up. Meanwhile, you've got a mortgage, private school to pay for, and you feel like you're getting further and further behind. Now, good news, if you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator, and it can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you. Check it out for yourself by going to wealthformulabanking.com.
All right. Well, so that's basically it for my predictions. And I know I've kind of off on many different tangents. So hopefully it's useful to you, at least to start thinking and doing some of your own research. Bottom line is this, as an investor, what can you do? I think the big story here is understanding that you need to be out of the dollar and into the investor class, because that widening gap between those who own things, who own assets, and those who do not is going to continue to widen. And so, my best, I won't call it advice, but my own belief is that it is a very good time to look around and look for assets that are underpriced, because I think everything is going to expand, and it's going to expand. And you don't want to be caught, on the dollar side of that equation. So that's it for me this week on Wealth Formula Podcast. Happy New Year. I'll see you next week. If you want to learn more, you can now get free access to our in-depth personal finance course featuring industry leaders like Tom Wheelwright and Ken McElroy. Visit wealthformularoadmap.com.